Okay, so this is a short clip on the analysis under the accounting equation. So I'm using example 2.12 from your textbook to explain how it's done. Okay, the following are miscellaneous transactions for top traders for January 2011, and we can ignore VAT. So VAT's still coming up in our syllabus, so we can ignore it for now. The business uses the perpetual inventory method with a markup of 60% on cost. Okay, so there's certain times where when you need to calculate the cost of goods, right? And they may give you the selling price, and you'll need to use that markup of 60% to calculate what's the cost of those goods. So you'll see that in some of the transactions here, and I'll explain it when we get to it. In terms of the perpetual inventory method, there's two methods, the periodic inventory and the perpetual inventory. Most businesses use the perpetual inventory. I will explain later what the periodic inventory is, right? And I've got other recordings of those. Okay, so let's look at transaction 1. Received a capital contribution of 205,000 Rand in the form of cash. So if it's a capital contribution, it means that the owner has put money into the business. So let's look at how this would affect your accounting equation. That's your assets equals owner's equity plus liabilities. So 205,000, your bank is going to be increasing with 205,000. So remember we said that with every transaction, there are two accounts affected. So we call this double entry. So here, our bank is going to increase with 205,000 and our owner's equity, because capital is owner's equity. So capital will be increasing because capital is coming into the business. So remember we spoke before about what owner's equity is made up of. It's capital minus drawings plus income minus expenses. So here, capital is increasing, which means your owner's equity is going to increase. And then remember we spoke about AED and CIL, right? That was in one of the recordings I had sent you all, and I had also did it in last week's, well, the lecture that we did previously. Okay, so AED, right? Assets, they have a debit balance. It means they increase on the debit side. So if bank is an asset, right? This is a favorable bank balance. So we have an asset and we want to increase it by 205,000. It means we need to debit bank. That's the reason why you see here that bank is debited with 205,000. Okay, and then capital. What is capital? Capital is the CIL. Remember I said AED and CIL. CIL, C stands for capital. It means that this has a credit balance and it increases on the credit side. So we need to credit capital to increase capital. So we are debiting bank, we are crediting capital, and these are the amounts. So in your assessments, they can either present it to you in this way, or they can have two more columns. After the date, they could have two more columns, one that says account debit and another one that says account credit. So if it's presented to you in that way, in the account debit column, you would put bank. In the account credit column, you would put capital. Okay, so it can be presented either way, but it's the exact same thing, right? It means the same thing. So if you understand how to do this, you'll be able to do it whichever way they present it to you. Okay, let's move on to the next transaction. So the next transaction the next transaction, I'm just going to read it from the textbook. It was the owner took clothing from trading inventory for personal use. The selling price is 850 Rand. So remember I told you that you may be given the selling price and you may need to work out the cost price with the markup of 60% that they gave you. So we need to do that here. So whenever the owner takes something from the business, when he takes trading inventory, he's not going to charge himself the selling price. He's going to charge himself the cost price. So we need to therefore use the cost price. So if 850 Rand is the selling price, if they tell you the markup is whatever percentage on cost, you'll take the selling price divided by 1 comma, whatever the markup is. Because it's 60% here, we're going to take the selling price of 850 divided by 1,6. If it were 40% on cost, we would divide it by 1,4. If it were 20%, if the markup was 20% on cost, we take the selling price divided by 1,2. Okay, and then you're getting the drift of it. Okay, so here we're taking 850 divided by 1,6, and that gives you 531 Rand and 25 cents. So that is our cost price. So when the owner is taking goods, it means that trading inventory is decreasing because trading inventory is leaving the business. So we are going to decrease our assets because trading inventory is an asset. So we're going to decrease our assets by 531 Rand 25 cents. And if the owner takes something for himself, we call that drawings. So it's like the opposite of capital. When he puts money into the business, it's capital. When he takes money out or even anything else, even not money, even if it's trading inventory, like in this case, it'll be drawings, right? So our drawings are going to increase. When drawings increases, the worth of the business decreases. Okay, that's why you're seeing a minus 531.25 in the owner's equity column. Okay, now to explain the debits and credits. So using the AED, assets have a debit balance, they increase on the debit side. So trading inventory is an asset. And here you can see that we want to decrease our trading inventory. So we need to credit trading inventory to decrease it, right? So of course, if you're debiting it to increase it, you would have to credit it to decrease it. So we're crediting trading inventory because trading inventory is decreasing. And then for the drawings, like when the owner takes something from the business, we said it's drawings. Drawings, AED, the D stands for drawings. Drawings has a debit balance. In other words, it increases on the debit side. And here we want our drawings to increase. So we're going to debit drawings. And then remember, if you figure out what's one leg of the equation, in other words, if you figured out you needed to credit trading stock or trading inventory, then you had to debit drawings, right? So you have to debit the other account. So if you can figure one out, then the other one is easy. It'll just be the opposite. Okay, let's move on to the next transaction. So for the next one, number 3, paid SA distributors by EFT for trading inventory purchase 7,000 Rand. So here you paid someone. Okay, so if you're paying someone, it means your bank account is going to decrease. Bank is an asset. It's going to decrease by 7,000, so minus 7,000 in your assets, and you are buying trading inventory. Okay, so it means your trading inventory is going to increase. That is also an asset. So you'll have plus 7,000 minus 7,000 in your assets. Okay, that's why you see this only in the asset column, nothing in owner's equity, nothing in liabilities, right? So your bank is decreasing. Bank is an asset, remember, AED, assets increase on the debit side. So here we want to decrease bank. So we're going to credit bank. We want to increase our trading inventory, which is also an asset. So we would debit trading inventory. So we're debiting trading inventory. We are crediting bank with 7,000 Rand. So plus and minus in the assets. Then the next one. Number 4, purchased an office printer on credit from Offer Pty Limited for 7,200. So we bought equipment. Equipment, the printer is equipment, it's an asset, right? So our assets are going to increase, okay, by 7,000 Rand. And remember, assets have a debit balance, okay, so we need to debit equipment to increase it. And because we bought it on credit, it means we now owe someone money. If you owe someone money, we call it a liability. Specifically, it'll be creditors control, right? So our liabilities are going to increase by 7,200, okay? And then our account will be creditors control, and we are crediting creditors control because the CIL, L stands for liabilities, and all of these have credit balances. So for it to increase, you need to credit it. So we are crediting creditors control to increase the liability. Then the next one is transaction 5. For transaction 5, cash sales of trading inventory, selling price equals 7,950. So here you can see it's a bit of a long explanation, right? So there's two double entries. Normally we have one double entry. One double entry is one debit, one credit. Two double entries mean two debits and two credits. So I did explain to you previously as well that whenever we sell goods for cash or on credit, there's always two double entries. So that's what we're seeing here. One is for the selling price and one is for the cost price. So the selling price of 7,950 Rand is given. So when you sell goods, your bank account is going to increase because here they told you it was a cash sale. So your bank account is going to increase by 7,950. Bank is an asset, has a debit balance. AED, assets, debit, the increase on the debit side. So you're going to debit bank. And then the other account that will be affected with the selling price would be sales. Sales is an income account, which means it forms part of your owner's equity. Again, owner's equity is made up of capital minus drawings plus income minus expenses. So your sales are going to be increasing, which means your owner's equity, the worth of your business, is increasing. That's what you see here, right? The credit to sales, right? So sales is income, CIL. I stands for income. Income has a credit balance. So it means it increases on the credit side. Therefore, we credit sales. So we're debiting bank, crediting sales with the selling price. Liabilities is zero, okay, because we don't owe anybody money from this transaction. Then the next part is to calculate the cost price of these goods. As I mentioned earlier, you take the selling price divided by 1 comma whatever the markup is. So because they told you the markup is on cost, you do this calculation. If the markup was on selling price, you would not use this calculation. You would use a different calculation for that, right? So for now, we're just looking at markup on cost. So it's your selling price divided by 1,6 because here the markup was 60% on cost. Right, so that should give you 4,968 Rand 75 cents. So your trading inventory is leaving your business when you sell trading inventory. So it means your assets are going to decrease by the cost price. Okay. And then you're going to credit trading inventory because trading inventory is an asset. You want to decrease it. So you're going to credit trading inventory. And then for your cost of sales is an expense. So whenever you sell goods, either for cash or on credit, you will recognize that sale and it goes to cost of sales. Only when you sell the goods, you recognize the expense. The expense is called cost of sales. So when I bought goods, I would have never put it to owner's equity. Nothing would have happened in my owner's equity column. So when I bought goods, it was bank and it was trading inventory. You remember that from the transaction that we did previously. It was number 3, transaction 3. It was just bank and it was trading inventory, right? Or if you bought on credit, it would be in your creditors control and trading inventory. So nothing went to owner's equity. It's only when you sell the goods that you recognize the expense for it, right? That's what we're doing here. So the cost of those goods was 4,968 Rand 75 cents. So your owner's equity is going to decrease by that amount, right? Because the worth of your business is decreasing because that's what those goods cost you. And then in terms of your debits and credits, cost of sales is an expense. We want the expense to increase. So AED, the E stands for expense. It has a debit balance. Expenses have a debit balance. If you want to increase the expense, you debit it. So notice that when an expense increases, it decreases your owner's equity. So even though we're debiting cost of sales is increasing, our owner's equity is decreasing because the worth of our business is decreasing. So now if you look at what's in the owner's equity column, we've got the selling price and then we've got the cost price. And you can see there's a plus for the selling price of 7,950 And then there's a minus for the cost price of 496,875. So the difference between the two would be your profit, right? Your selling price minus your cost price. So the net effect is your profit, and your owner's equity is increasing by that profit. Okay, but you have to show these two double entries separately. You can't just show the net effect because the accounts that you're debiting and crediting are different for them. Okay, so that was an example, 2.12 from your textbook. Thank you for taking the time to watch this recording.